Oh, hi everyone. My name's James Gerrish. I'm going to give it a couple of 1 or 2 minutes just for the remainder to come in and log in to today's webinar. So I'll be back with you in just one moment. All right, guys, while we wait for the final attendees to arrive, I'll just run through a quick bit of housekeeping in terms of the disclaimer around today's webinar. It is general advice only, so you should consult a financial professional before taking any information on board today. Again, it's general information at best. So just to give you a bit of background, my name's James Gerrish. For those that may not already know, I'm the primary contributor to Market Matters. That means I write the bulk of the Market Matters content. I'm the major shareholder in the business. So aside from that, I'm also a portfolio manager at Shaw and Partners, which is a large wealth management and asset management company here in Australia. I run a team of around 11 throughout both businesses. We're active day to day in the market. We've got an institutional component of our business. We manage wholesale portfolios, running a couple of $100 million through that business. And I guess that's what sets Market Matters apart from the other potential reports, etc., that go out on a day-to-day basis. We're right at the coalface. I'm at the coalface on a daily basis. Interacting in the markets on the institutional as well as the retail side. So in today's presentation, I want to get across our views going into the back end of the year. It's been a pretty choppy time in the market. I think we can all agree that October was a pretty dismal month in terms of the market. To give you some context around that, we had a high in August, the back end of August, at 63.73. The market's now corrected 11.7% from high to low in terms of the ASX 200. That's 749 points. So you can clearly understand why some would be questioning whether or not this year we'll be getting the Christmas rally. I know Len in our office, who's a perma bear, has been questioning it. So I want to start around giving you some statistics around the Christmas rally and why it does have validity, and then we'll knuckle into some of the topics that I wanted to address throughout today's presentation. The ASX 200 is on the chart in front of the screen, just to give you an idea, and we'll go back and have a look at that very shortly. On the screen, what I'm showing you is a simple heat map which outlines the returns on a monthly basis over time. So 5 years in terms of the ASX 200. So this is looking at the performance of the ASX 200 on an annualized basis over the last 5 years. So in the last 5 years, we've had 5 positive runs in the Christmas. If I expand that out to 10 years, it gives you more validity in the data. So we've only had one December into Christmas where we haven't had a Christmas rally. If I go even further out in the last 20 years, you can see that in the last 20 years, we've had 5 Decembers that have been weak out of 20. So that's a 75% hit rate in terms of running up into Christmas. And if we go out 30 years, so the data has even more validity, then we get 5 declines in December relative to 24 months where we've seen advances into December. So, by going out there and making a claim around, the Christmas rally, it's out there because it has statistical significance. We try and base our views around data and substance as opposed to simply views. If I stand back, and I wrote this about a little while ago, just after the US midterms. So the US midterms happen every 4 years after a new president comes in. The US midterms happen thereafter, and there's a really bullish significance around that. In the last 18 midterms that have taken place, so since they happen every 4 years. So since World War II, I should say. We've seen 18 advances by the market, and 1 year later, the average return of the market 17%. So I guess that you get a data, you get a confluence or a combination of data sets to look at and ascertain views on the market. So I guess in a nutshell, what I'm attempting to say here is the Christmas rally is still on the table. It has statistical significance. There's reasons for that. And right now, the one thing I want to get across is more not whether or not the Christmas rally will happen this year, but at what point or what level in the ASX 200 the market is going to rally from. So if I go back to the chart of the ASX 200 that I showed originally, we're trading at 57.26. So we've had that big aggressive decline from 63.73 down to 56.24. We're in this distribution last week. We had a target on the market from the lows of 59.24. Given the bullish nature or reasonable buying in the market, we probably thought it was going to go through that 59.50 level and go on with it. It hasn't done that at this point in time. So now we sit back and think about where's this rally going to take place from, and ultimately the scenario that we're looking at now is around this 5600 level. So again, it's around where the rally is going to happen from, in our view, over and above whether or not that Christmas rally will take place this year. So we'll be looking to increase our equity weighting again on a move or a test around that 5600 level. The other important factor is around what sectors to buy. So what areas of the market do we want to target if that's taking place? And I think, a lot of the things we write about in our reports are around the macro backdrop of markets globally. I think there's no time in recent memory where that macro backdrop isn't as important as it is now. So, whether or not a company is cheap or expensive is very much dependent upon what the macro backdrop is at that particular point in time. Interest rates, sentiment, the flow of money globally is a really important concept that we try and keep a handle on a daily basis here at Market Matters. So I'm going to focus on the sectors that we like, the sectors that we don't, and what is underpinning that. So one of the big I guess not one of the bigger calls, but one of the main calls underpinning our views in the market is around interest rates. And it's not a rocket science to say that global interest rates have been going up, but a lot wouldn't understand that interest rates, particularly in the US, have been going up fairly aggressively. So if we look at the US 10-year bond yield, and we go back, and we'll put a weekly chart on that and go back over the last 4 years, you can clearly see that US 10-year yields have based out at 1.31%. We're now coming at 3.12%. So that's a meaningful rally in US bond yields as markets have improved. If you think more broadly about the backdrop, we've obviously had the GFC, a major shock to markets. The response to the GFC was a massive cutting of interest rates, a massive global stimulus program by central banks printing money and buying bonds to put downward pressure on long-term interest rates, and it's worked. It's really worked in the US economy. The US economy is performing pretty well. Unemployment is exceptionally low, and the economy is performing reasonably well. So the backdrop there is around, if the economy is doing well, then interest rates should go higher. There's just one point around that I'd like to make as a shorter term tactical point at this time. So we think US interest rates and global interest rates are going higher over time. That's the backdrop around how we're investing. So we need to be conscious of the sectors, etc., to be invested in that. In the very short term, interest rates are a key consideration in the short term around when we go in and buy those sectors and when we want to avoid sectors. So if you've got an interest rate sensitive sector, it's a sector that is bond-like in nature. So it could be an infrastructure stock, it could be in the real estate space, things that are exposed to rising interest rates, etc. It makes sense, right? So on the screen in front of you now is world interest rates expectations. So if we're saying that US interest rates are going higher, we want to see how the market's positioned around that theme. So does the market agree with us? Is the market consensus call all in one direction? So that's a really important thing. We look at it in terms of stocks and we look at it in terms of macro data as well. So without getting too complex there, if I look out into December, the probability of a rate hike in the US is now 71.8%. So there's a 71.8% chance of a rate increase in December for the US market. That has come back. That was about 2 weeks ago. That probability was around 95%. So that is reduced a lot. Why is that reduced a lot? If you look at the oil price and the US dollar, it'll tell you a very important thing. So interest rates are very much linked to inflation expectations. Inflation expectations are linked to obviously rising prices. Oil is very inflationary when it's rising and very deflationary when it's falling. And I think that's one of the major reasons why in the last little while the expectation of interest rate hikes in the US have come out a little bit. So I guess from an asset allocation or sector point of view, we need to be conscious of that. So if we're suggesting, and I'll look at some sectors right now to give you an example of it. So if we're looking at just before I go on to that, I'll just touch on what Australian interest rates or the futures market are pricing in terms of Australian interest rates. So there is really no probability of a hike until we get out into March of the 3rd of the 9th 2019, so the back end of 2019 calendar year, and that's when we just get a 50% probability of an interest rate hike here in Australia. So futures markets, that's where the smart money tends to be. So there is no interest rate hikes priced into the market until the back end of calendar 2019. If I go back to some of the stocks that we're looking at in terms of interest rate sensitivities, etc., Sydney Airport's a really obvious one in terms of the stocks, the areas of the market that we've avoided and will continue to avoid based on rising interest rates. I've written about this at length, but things that carry a lot of debt, things that have got returns that are very stable, but an interest rate, an environment where interest rates are going higher, they will underperform, or they will likely underperform. It's a pretty, without going into the detail, but higher interest rates play into the risk-free rate when you put a valuation model in place. So if you can get a higher return by taking no risk, you obviously need to get an even bigger return from riskier assets as interest rates go high. You need to be compensated for taking on that additional risk. So it makes sense. So if you need to be compensated to be taking on additional risk, you need to be buying at a lower valuation, and that's the negative influence on these sort of stocks. If we look at something like a Stockland, for instance, in terms of the property sector in Australia, these guys have got residential property, etc. So they do have other issues other than rising interest rates, but it is a very indicative company in terms of what's happening in the Australian, or the appetite for Australian residential or property, as well as the broader property environment here in Australia. So Stockland and other real estate companies would be areas that we would avoid. The other area of the market that typically struggles in higher interest rates, so if we were is higher valuation growth stocks, and we've seen a lot of those come under a fair amount of pressure. Appen is one I've spoken about in the last few reports. So we've seen stocks like this come under a fair amount of pressure since the back end of September. Appen, to give you an idea, it's traded to a high of $16 and it's down there at $11.30 or so. So it has been under some significant pressure. High growth stocks usually struggle as interest rates rise. There's a lot of optimism built into high growth stocks. In an environment where interest rates go up, then that becomes or creates a greater headwind for these sort of growth orientated businesses. CSL is a really good example. We have this one in the portfolio, and I'll put a question out there. What PE multiple should CSL trade on? It's a sublime company. It's got a great flow of earnings. It's really predictable. It's been growing those earnings at a great clip over a lot of years. But what PE multiple should a stock like CSL trade on. And the macro backdrop, the appetite for risk, the appetite for growth orientated or these sort of businesses will play into that. So if I go and look at a quick CSL PE bands, so while it loads, I'm going to look at not first comps, which is the other competitors in the landscape. I'm going to look at it versus itself. So this looks at CSL's PE over time relative to itself. So in the last 5 years, CSL has traded between 18.8 times and 37.4 times. So it got to 37.4 times when it was recently, before the recent rout in the stock price. CSL's earnings haven't really changed much. The growth rates haven't really changed much. It becomes the market's appetite to pay for that growth, and that obviously is impacted by what's happening from an external standpoint. It's also impacted by simply the perception of risk in the market. So if I'm looking at CSL right now, it's trading on 29.2 times. That's down from 37.4 times it was trading at. So it is, it's over on a 5-year view, it's still 16% expensive on a 5-year view, but it's less expensive, it's significantly less expensive than it was previously. So if we put CSL on a historical average multiple, it should be trading at $157.62, as you can see here. My expectation, or why we hold CSL now, I think that the macro backdrop is a negative influence on CSL at the moment, as I just said. The nearer term earnings have been probably better than the 5-year average in CSL. So in my view, it can withstand a slight PE multiple premium to what it's traditionally or historically traded at. 37 times CSL is way overextended, and on 20 to 25 times earning, it's stretched too far to the downside. Right now, it's one standard deviation is expensive, and that's why we view CSL and other growth areas of the market as more active trading stocks in this sort of environment. The market dynamic has changed. We've had 10 years of a pretty aggressive bull market in global equities, forced by low interest rates, a lot of stimulus, etc., going around the system. So I think the backdrop gets harder from here. I think the macro elements that are playing out in the market, the changing dynamics of interest rates in global liquidity and what's happening with Chinese US trade, etc., are really important factors that as an investor you need to be across on a daily basis. And I guess that's what we try to bring to investors in terms of what the market matters. Daily notes, portfolios, etc., are all about. One of the interesting things, and I touched on inflation and the outlook for growth, etc., going forward. Resource stocks that typically do well in an inflationary environment. It's one area of the market that we are looking to increase our exposure to. So if you think about the discussion that I just had before, and I'm just going to go down to one of our recent purchases in the resource space, which is Western Areas. If you think about the backdrop of the market that I spoke about before, if we've got this expectation, that interest rates are going higher long term, but in the very short term, the backdrop of lower oil prices, a higher US dollar, etc., has been a negative for inflation in the short term. Interest rates probably stay at these levels or go a little bit lower in the short term. That's why growth stocks are probably near a low in our view for a trading opportunity to buy into Christmas. I'm going to highlight that very soon. The other thing is that resources stocks will probably base out when interest rates do decline. Resources will probably decline along the way and present some trading opportunities for us at the back end of November and in early December, and that's how we're going to be positioning the portfolios going forward. Banks and financials typically do well in environments where interest rates are going higher. I'm going to look at the Australian banks because it's obviously very important. Before I do, I just want to touch on Western Areas that I started to speak on a couple of minutes ago. Now, this is a nickel producer. It's reasonably It's a new addition to the portfolio. We bought it in the low 220s. While we bought it, we like one of these patterns on Western Areas. Beside it being a well-run company, it's got net cash on the balance sheet. It's been unloved. It's traded down from $4 down to $2.20. They've had some slight production issues, which have been rectified. So from an operational standpoint, this company's going very well. We like the technical side of this, where it goes down and makes a marginal new low after a reasonable decline. So in our view, Western Areas is a good risk versus return, risk versus reward buy around these current levels. So that's an idea in the resource space that we currently hold in the portfolio. If I look at the banking space, I'm going to use CBA as a proxy for the banking space. It's obviously the larger bank. It's having a pretty poor day on the market today, and indeed on this week. If I go down and have a look at in terms of the daily chart in CBA, banks typically do well as interest rates rise, margins expand, etc. Insofar as if we don't go into recession, if we don't have a big deterioration in asset prices, if we don't have a big uptick in bad debts, etc. So in other words, if the economy doesn't fall apart, banks typically do well as interest rates edge higher. So in terms of CBA and valuations, there's been a lot written about banks and whether or not their long-term reign as good investments have ended. Right now, that negativity, in my view, presents an opportunity in the bank. So, we've got a reasonably high allocation in our portfolio in the banks at this point in time, and I've written recently, I'd rather be a buyer right now of something like a CBA over and above something like a BHP. I think BHP goes lower, and I think there will be a buying opportunity in that stock. But right now, if I look at the valuations in terms of banks. So I think the macro backdrop is supportive of financials going forward. I think if we look at what's happened in Australia in the last few months or 6 months or so, banks have been hurt obviously by the Royal Commission, but that's now a known. If the Australian property market doesn't fall apart, then banks are certainly a buy down here. If I go and look at valuations in terms of CBA, again, as a proxy for the broader market. One of the interesting notes was out during the week just around the banking space here in Australia. So they're trading at about a 39% discount versus the broader industrial. So that's a pretty significant discount to the broader industrial market here in Australia. Over time, they trade on a 30% discount to normal valuations or normal industrial valuations here in Australia. If I look at CBA in terms of, we're looking at versus self now. So CBA over time versus self, generally it trades on a historical average PE of 14. It's trading on a current PE of 12.4. So that makes it about 11% cheap in terms of where it generally trades. But that said, the sector is cheap at this point in time. So if we put CBA on a historical average PE, then CBA is worth $77.93 right now versus the $68.40 it's trading at the moment. So, in my mind, so the banks have got some headwinds. They're known headwinds. The impost of the Royal Commission has now is a known. So we know that the big four banks have about a $5.2 billion cost associated with the Royal Commission, and that's in FY18 and expected in FY19. So that's the known. The unknown known is that around property. So whether or not property will fall out of bed completely in Australia, or it will continue to have a more more measured pullback as arguably what it's doing at the moment. If I go back and look at CBA and look at CBA relative to the other banks in the sector, because as I said before, the banking sector collectively is obviously cheap at this point in time. So the group dynamics of the banks, and this is interesting. So if we've got an overweight call on the banks, which we do, we want to have a really good handle on how these banks are performing as a group, but also within relative to the different constituents in the sector. So if you think of NAB trading on 10.2 times, so that is cheap relative to the sector. So it's trading on an 8% discount to the sector, but the historical average is 6% discount. So NAB, because it's a lower quality operation than something like a CBA, which garners a premium to the sector, it's trading on a discount, not a hugely different discount to what it generally trades at. CBA, for instance, typically, historically, over the last 5 years, trades on an 11% premium to the sector. Sort of reasons for that. The CBA has a better return on equity, significantly better return on equity. They've got better systems, and there's a lot of things that underpin this premium that CBA typically trades at. So that's about right around what it generally trades at. It's trading on 12.4 times versus sector on 11.1. If you're looking in terms of relative value in the sector, Westpac is trading at a 3% discount versus a 2% historical premium. So that's that. Westpac is relatively cheap on that metrics. And then if you look at the second tier, the regional banks, we're not as keen on the regional banks at this point in time. There's reasons for it around funding costs, etc. If global asset markets become volatile, then it hurts regional banks more than it does the big four. But yeah, if you're looking for a relative valuation of the banks, then Westpac is a potential purchase in terms of that. I'll just grab a quick chart of Westpac up there to show you where it's trading at. So we do own Westpac in our portfolios. And it has just gone ex-dividend, so it's trading at 25.13. It's gone to a new low on the market today. So clearly sentiment around these banks are negative. We've got a view of going against the grain. So not buying optimism, buying pessimism, and trying to sell optimism. I think that's the environment that we're going, or the market shape that we need to be across over the next 12 months or so. You've got to be, in our view, you've got to be more active in your allocations, more active in your stock pickings, and sort of go out there and go against the grain as opposed to following the herd. We saw what happened to the herd who was in the high value technology stocks. So I'll just get up an example of that. Afterpay, again, a great business, a great idea, a simple product that has got so much cut through in the retail market, but what should it trade on? Should it be trading on 100 times earnings, 200 times earnings, 50 times earnings, or do you even worry about earnings in terms of Afterpay? Do you simply go on and look at the number of merchants that it's adding over in the US and say, look at the addressable market, that is a huge opportunity for Afterpay, and go and pay any price for it? What I would argue is that these are sentiment stocks. The sentiment can change pretty dramatically. Afterpay has halved since August of this year. The sentiment has changed in that area of the market, and that's why we've seen large moves in share price. If I compare Afterpay, for instance, I actually don't. If I look at relative valuations of Afterpay, so it's trading on a PE of 556 times. Sorry, it's trading on a multiple of 50. It's trading on a PE premium of 556% above where it generally trades at. Like, it's massive. If I go and look at Apple, for instance, so Apple in the US. So your typical bellwether growth stock, large cap US, etc., is a proxy for this broader sector, and why some of these valuations in Australia simply got out of whack. So Apple's trading on 13.7 times, and in terms of earnings growth for Apple, earnings growth on an EPS level is going at 13%. So you're paying 13 times for a business growing at 13% per annum in terms of their underlying earnings. A huge market, a really mature business. If you think of where the share price has, or the valuation has come from, and where it could potentially go into. So if I look at it versus itself over the last 5 years, it's had a high of 17.1 times. It's had a low of 10 times, basically 9.7. And it's trading at 13.7 times. So to me, that's coming back like that's a better risk reward proposition than going out there chasing hugely sentiment driven um, domestic stocks. I'm not saying you can't trade them in the short term because I think there's opportunities, trading opportunities in the short term, but I think it's very much sentiment driven. So I guess that was the point I'm trying to make around growth versus value. So the growth area of the market is very much influenced by the sentiment at the time, and they're very much influenced by what we're seeing on the macro level. Whereas value has been out of favour in the last 12 months, 24 months. If you look at the return of value managers, they've been incredibly weak. But in my view, you've always got to drop things or anchor things to valuation. If you're trading growth, you've got to be looking at sentiment, you've got to be looking at the technicals, etc., which we do. One growth opportunity that I have written about recently, we think this will be a stock that we could go and buy into further weakness. So Altium, great growth business. They do have sustainable earnings, etc. Printed circuit boards, a very good business. And if that was to trade under 20 dollars a share, so we're trading at 22.27 at the moment. So if we had this stock go in and make a marginal new low, that's a sort of risk reward opportunity that we'd go in and buy. You can quantify your risk in a position like that. You've got a multiple of potential upside versus the risk that you're taking on, and they're the sort of opportunities that we're out there trying to look for every day and putting out to our subscriber base. So that's it. We're not against growth, but I think you've got to be really nimble in terms of the growth outlook for something like a Altium, etc. One of the interesting things, and this will probably highlight growth versus value over the last few years at least. In the orange line, I've got the Nasdaq. So that's the US tech sector on the orange line there, and on the white bar chart you've got the Dow Jones Industrial Average. So if I go and look at it back in time and go back a little further, so go back 10 years in terms of what we've seen in growth versus value, there's been a massive there's been a massive flow of money into growth-orientated businesses that are dominated by the Nasdaq. These more mundane, boring blue chip stocks that are traditionally housed in the Dow Jones Industrial Average have underperformed. So I think we're going, given the macro backdrop that I've just outlined around interest rates, around stimulus being wound back, etc., around volatility in asset markets, I think we've got to be focused on the fact that some of these growth areas of the market may start to underperform. Some of these value areas of the market, some of these boring blue chips, we can actually go out there and make some good money being active in our blue chip shares, and that probably speaks to the Australian market. So the Australian market is very much dominated by old school blue chip style stocks. If I look at the member weightings, the composition of our index here in Australia, then it is old school blue chip. So that's why one of the reasons why I would suggest historical summary. It's one of the reasons why I strongly believe that the Aussie market, the local market, is going to go into a period of outperformance, I should say, versus what we're seeing in US market. US is a very tech growth orientated market. There's a lot of reasons for that. Their taxation system is more set up towards reinvesting in growth. They support entrepreneurs. We don't do that so much here in Australia. We're more around, our market is set up for yield, dividends, etc. But I think that's going to present a really good opportunity in the coming years if we can position correctly in some of these more mundane blue chip stocks, be active around our allocations in them. I think that's probably the lower risk way to approach the markets going forward, and that's certainly what we will be how we'll be positioning in terms of market matters and continuing to put out recommendations associated with that. in the original email that went out, there was a discussion around whether the healthcare sector is a buy, whether it's a sell, what is going on in terms of the healthcare sector. It's a pretty broad sector. It's a pretty broad church in terms of what sort of companies are within that healthcare sector. I'm just going to speak about a couple very shortly. I'll just get up the healthcare index. It is one. All right. Now I need to get rid of that. Bear with me one sec. All right. So this is the healthcare sector, a very long term chart of the healthcare sector monthly over 10 years. If I put it back in terms of what we're seeing in the shorter term, you can clearly see the healthcare sector peaked earlier in the year, and we've been a downhill battle ever since. So if you think of the Aussie healthcare sector, you've got some of these really strong quality businesses: ResMed, CSL, Cochlear, etc. These are very high quality businesses, but it comes down to what you pay for them. Then we've already seen a big re-rate in the likes of Ramsay Healthcare, for instance. So this is a hospital operator that that growth started to slow. So it had phenomenal growth over a lot of years. It attracted a massive multiple to what the market was trading at. It's been through a more turbulent last 2 years, and the stock's trading at $55.50. We own Ramsay Healthcare in our portfolio. We've bought it into the recent weakness. We're reasonably optimistic for a short-term bounce in terms of Ramsay. I was on their AGM earlier in the week. They talked a big game. I think one of the major things that we've seen in the last little while in terms of Ramsay Healthcare is that they've been investing, positioning their business, cutting costs, investing for the future. They've bought they've bought half of a business over in the overseas called Capio. It's more focused on the technology aspect of health services. I think that's going to be a really big growth area in terms of health services going forward. If I had $1 for every time I've read about the aging population and the huge dynamic about that being supportive of healthcare stocks, I'd be fairly wealthy. I think that theme is such a well-known theme, a well-spoken about theme, that it's no longer really relevant. I know that it's a long-term driver for earnings of a business like this, but all you've got to go and look at is something like an Estia Health or some of these aged care providers who they are at the front and center, the benefit from the aging population. Yet Nestia Healthcare has gone in 2015. It was trading at $7.41, and today it's trading at $2.17. So, I guess what I'm trying to get in across in that context is that the majority of investors out there will have positions in their portfolio that they would rather not. We have positions in our portfolio that we would rather not have. You've got to manage those positions on a regular basis. You've got to be making the tough calls in terms of ripping the band-aid off positions that have gone against you. And I think that's one of the key selling points, or the key elements that we do at Market Matters. We try and take the emotion out of trading. We're managing a reasonable amount of money, and it's I guess taking that emotion out of the daily activities within the market is how we can help everyday investors out there. We're riding, as I said at the start, we're riding from the coalface, and I think this market going forward there's going to be a really big need for that sort of approach. I want to finish up and wrap up just today's quick webinar, just looking at the banks and resources and where we should be playing the market in terms of those two dominant sectors on the Australian bourse. So I showed before that banks account for financials account for about 30% of the index. Materials are the second largest weighting on our index. We've had some pretty big, I'll just grab BHP on the chart there. So we've had what's happened in the resource space in the last little while, and I think this is an important concept going forward. In years gone by, resources have spun off a lot of free cash, and what they've traditionally done is gone out there and purchase other assets, purchase future growth, and without being too harsh, in the majority of cases, they've stuffed that up. They've bought assets at highs. Right now we're getting BHP is returning $10.5 billion back to shareholders from the sale of shale assets over in the US. They paid a lot more for. The market is cheering that they're giving back money to shareholders, but they have ripped up money in terms of going out there and buying growth. So what we're seeing at the moment is a large proportion of the domestic miners with net cash on their balance sheet, but we're not seeing them go out there and reinvest in growth going forward. So in terms of resources being boom and bust, normally you have commodity prices rise, that incentivizes new production to come online, that incentivizes future growth in the development of mines that at lower prices are uneconomical. We're not seeing that at the moment. So we're not seeing new money go into the ground of resources generally, or as much as it has done in the past. We're seeing money go back to shareholders. So I think that's a good thing in this sort of environment. But what it says to me is that commodity prices at this point in the cycle, whether or not they, I see a positive backdrop over the next couple of years around commodity prices. So, we want to increase our allocations into the resource space into weakness. I think resources, commodity companies are more trading vehicles. They're active vehicles that you need to be more active in. Just look at the oil stocks in the last little while. There was if I this is a really good example in terms of, or I think it's a really good example in terms of Santos. Looking at a weekly chart in Santos, I read a huge amount of broker research. I read a lot of information coming out of companies. And back at this peak in October, that's when Santos came out and said they were going to double production in the next couple of years. So the oil market was bullish. We've got analysts upgrading oil expectations to $80 a barrel. Oil is now trading around $55 a barrel. So I think one of the important things in the commodity space is having your finger on the pulse in it. I think there's going to be really strong opportunities in the commodity space going forward, but again, it's having one's finger on the pulse and not typically going in the direction of what the bulk are going into. So right now, when BHP was trading at $34, and that's the last point that we sold BHP. So that's been our last sale price in terms of BHP. I work in a big dealing floor. There's 100 and something people on the floor that I work in. The majority were bullish in terms of BHP at that point. When the market is bullish a particular theme, it's a known. Everyone's positioned on the already positioned in the stock. Where's the next buyer going to be? So, in my view, BHP goes back below $30, and that's where we'd go and be a buyer of that stock. In terms of banks, I think you can, and again, using CBA as a proxy, I think you can buy weakness, but again, we'd be sellers of strength in terms of the banks. And if I just end on what we see in terms of the Australian market in the near term, so we've had, the market's been incredibly weak. We're down here testing the 5,700 on the ASX 200 again today. So our expectation is a test of 5,600. If it dips below 5,600, will be more aggressive buys in terms of the markets. More sophisticated investors out there can consider option strategies. We can sell call options over the top of high yielding stocks to generate reasonable returns. It is a more sophisticated strategy, but that can be useful for some investors out there. Again, I thank you for listening to this presentation. For those that may not be a subscriber to Market Matters, I'd encourage you to take a trial or subscribe to the service. We do try and add value on a daily basis. We call it as it is. We're involved directly in the markets. We're seeing flows in the markets. We're seeing how the broader market is positioned, or we're trying to ascertain how the broader market is positioned. I think going forward, the macro backdrop, and I hope I've stressed that enough through this presentation, I think the macro backdrop is going to be incredibly important going forward. So once again, thanks for your attendance today, and I look forward to speaking to you again soon. Bye for now.